Hi folks, it's Todd Keffury at Cadenza Financial Planning. Today I wanted to break down the different structures of firms in the financial services industry. Why is this important? Well, because as a consumer of financial services, it's really important to understand how the firm that you're considering working with gets compensated and what services you can expect to get for the money that you're paying them. So the first firm type is a registered investment advisory, of which Cadenza Financial Planning is one. RIAs are fee-based, usually independent fiduciaries that provide financial advice, commonly in a fee-only format. In other words, they derive a bulk of their revenue from financial planning, either on a one-time or an ongoing basis. They may also provide investment management services, build and manage investment portfolios, and so forth. So fiduciary is the key word here. When RIAs are held to a fiduciary standard, that means that they're bound to act in the client's best interest. They do not accept any fees or compensation based on product sales. Fee-only advisors generally have fewer inherent conflicts of interest, and they generally provide more comprehensive advice. Under this fiduciary standard, regulatory bodies like FINRA, which is the Financial Industry Regulatory Authority, and the SEC hold RIAs to a higher standard than broker-dealers, as broker-dealers only must follow a suitability standard, which we'll go over the difference in a minute. So the next firm type is a broker-dealer. Examples of this may be Ameriprise or Raymond James or LPL Financial. And these firms are primarily compensated, they're transaction and commission based, meaning that they're in the market to sell you insurance and investment products that generate commissions for the firm. So I explained the fiduciary standard a minute ago. The agents or advisors at broker-dealers are not held to that standard. Instead, they're held to what's called a suitability standard. That is, they can only recommend a product or investment that's suitable for a client. Now, here's the difference. It might be deemed suitable for a financial advisor to recommend to a client the purchase of a $500,000 annuity if that client has, let's say, $2.5 million. In other words, the insurance company, the financial firm, and regulators will all conclude that the purchase of this annuity contract is suitable, as it represents only about 20% of that client's total assets. Unsuitable would be something like trying to sell them $1 million annuity. However, there's no obligation for that advisor to determine whether purchasing that $500,000 annuity contract is actually in the client's best interest. That determination can only be made through thorough and comprehensive financial planning. In other words, just because you have $500,000 burning a hole in your pocket doesn't mean that the purchase of the contract is the best thing for your overall financial plan. So the next firm type is the hybrid. Examples of this would be Merrill Lynch or UBS or Morgan Stanley or Fidelity. These hybrid firms operate both fee-based, like the registered investment advisory, and commission-based, like the broker-dealer. In this hybrid structure, many advisors are captive in that they're often told what products to sell, what stocks to recommend, what insurance products to recommend. And these recommendations are usually the result of special arrangements between the firm and particular insurance carriers or mutual fund companies. So how does each of these charge? Well, the RIA charges by either a percent of the assets that they have under management, or there's some sort of fee that's based on the service, usually in the form of financial planning fee. The broker-dealer gets their compensation from transactions and commissions primarily. That's stock or mutual fund trades, mutual fund sales charges, alternative investment sales charges, and insurance commissions. The hybrid can charge on a percent of assets under management plus transactions and commissions. So it's basically a combination of both the RIA and the broker-dealer. So how do each of these charge? What do they cost? The RIA usually is about 1 to 2% of the assets under management, or like I mentioned, it's a fixed fee or some sort of fee based on the planning. With asset fees, depending on how much they're managing, fees can range from 1 to 2%, sometimes more, sometimes less. The broker-dealer charges transaction fees plus commissions on insurance, annuities, investments, alternative investments, and that fee can range anywhere from 6% on upward. With alternative investments and variable annuities, for example, these charges can even go up to 10%. So there are several problems with this model, but I'll go through, I'll touch on just a couple. Those insurance and annuity products that pay high commissions to the selling agent or advisor come at a cost to the person that's buying the product. So the insurance company is essentially prepaying the selling agent a part of the overall cost of the contract. How does this translate to you, the consumer who buys the product? Well, the first is in the form of an often lengthy surrender period, during which you cannot get out of the contract without paying a stiff penalty. This surrender period is put in place by the insurance company to make sure that they can recoup the large commission that they prepaid to the agent or advisor that sold you the product in the first place. Another detriment to the consumer from high commission products is in the contract itself. If the insurance company has to pay the agent or advisor a large commission, what that means is that the benefits your contract offers will be likewise less than if you had purchased a low or no cost contract or policy. So these are just a couple of the reasons why fee-only financial firms don't receive sales commissions. Instead, their recommendations for insurance or annuities are usually referred to low or no cost insurance brokers who don't have hefty sales commissions built into their products. And finally, the hybrid will charge for assets under management, like a registered investment advisory, plus a sales charge on many of the mutual funds that they recommend. And that can be up to anywhere up to 5.25% on a mutual fund. Plus, those mutual funds have annual expenses that can range from 1.5% to 3% or more, and that's every year. Most mutual funds have something like 15 different expenses built into them, only 3 of which they are compelled to disclose to you as the investor. It's one of the reasons that Cadenza doesn't use mutual funds in our investment portfolios. They just cost too much, and with low-cost alternatives like exchange-traded funds, we just see mutual fund universe as an archaic investment vehicle. I mean, there are other reasons we don't use them. Their unwieldy tax treatment, for example. But I'll tell you, someone has to pay for those mutual fund wholesalers that visit hybrid or broker-dealer offices and take the star producers out to wine and dine them at 3-star Michelin restaurants. Someone has to pay for all those analysts. Someone has to pay for all that advertising, and that would be you. Plus, there is also the potential with the hybrid for the huge commissionable sale of insurance policies, annuity contracts, and alternative investments, like the broker-dealer. So as we saw earlier, this idea of fee-only and fiduciary really serves anyone who's looking to keep costs down. But more importantly, it's the firm type that you're most likely to find a focus on comprehensive financial planning. These firms will always provide honest advice. You can generally leave the firm at any time with all of your assets, and many operate with an affordable monthly retainer model with zero hidden costs or fees. You may hear them self-described as financial advisors or investment managers, but within the industry, they're referred to as producers, because in this model, they're compensated by selling products. And we saw earlier how that suitability standard doesn't protect you from an advisor giving you a recommendation that's not in your best interest. Finally, we have the hybrids, who some would argue offer the best of both worlds, right? Investment management, access to lots of sexy insurance and investment products, and whatever additional pieces they can cobble together loosely, and call financial planning. But in reality, it offers the best of both worlds to the firm and to the producer. You can see how this hybrid model can get really, really expensive. And incidentally, most of these firms will still refer you out for fundamental financial planning services that they should be providing in the first place, such as estate planning and tax planning, things that will cost you even more money. But perhaps the biggest problem in this model, and the one that regulators and the Department of Labor is pressing the industry on, is the conflict of interest. How can you be sure that a hybrid firm is following a fiduciary standard in your best interest, or a suitability standard in the recommendations and advice that they're giving you? Without a clear delineation, how do you really know that their recommendation for you to buy that $500,000 annuity is in your best interest or not, if they're able to have one foot in the broker-dealer world and one foot in the RIA world. So I hope that this has been an enlightening presentation, and it's gone at least a little way toward peeling back that veil the industry likes to keep well protected. As always, if you have questions or would like to discuss the potential benefits of working with a fee-only fiduciary registered investment advisory, please visit cadenzafinancial.com to schedule an initial discovery meeting, or call us at 702-546-6404. Until next time, remember, part of fighting the man is understanding the man.